All right. Today is Monday, the 25th of December, aka Christmas. Merry Christmas, everybody. Happy holidays. Even though it's over, except for the 3 viewers who are watching the program from Alaska tonight. But anyhow, a Christmas message for you. You know, this is a time of joy and happiness and getting together and all of that, but for a lot of us, it's not. You might feel a little low, a little lonely. You're not at the place where you want to be in life at this point. You got to remember one thing here, though. A lot of us been there before, and it gets better. And at the end of the day, you're the captain of the ship. You're the hero of your own movie, and you're in charge. And maybe you're not at the place you want to be right now in your life, but you're still in charge. Maybe you're not ready, but when you're ready, you're going to grab that steering wheel and move where you want to be in life. You don't need to do it right now. You don't need to live by anybody's standards. Your standard, your goals, your pace is what's important. Anyhow, this is supposed to be a members only video, but Uncle Mav is feeling like Santa Claus, a little bit generous today. So I'm opening this video to everybody as a Christmas gift. And for the members of the channel, rest assured I've been wrapping a lot of gifts for you over the weekend. And this is just an example, a sample of what we're going to do, but we're going to have many more of those. But folks, let's get right into it here. Anybody watching the stock market and the economy in 23 knows that it was the year of the big caps, the aka Magnificent 7. Those names happen to be Apple, Microsoft, Alphabet, Meta, Nvidia, Amazon, and Tesla. We have seen the majority of the recovery in the stock market in 23 led by these names. Without their performance, we would not be at this point right now in the stock market. We would not have the level of confidence that we have right now in the economy because of the wealth effect that we gain from the stock market. But right now, after such an outperformance by the Magnificent 7, the big cap technology stocks versus the rest of the components of the S&P 500, their weighting right now is too big, at about 30% of the S&P. In other words, these names are now too big to fail. These names have to continue to perform. The stock market depends on them. The U.S. economy depends on them. And the question now becomes, can they replicate the performance and the comeback in 23 and add to it in 24? You know, I've been working on this video since Thanksgiving, and I've been thinking about the point here. What is the point of doing such an analysis? And the point being here is there is one consistent theme that took place in the majority of these names in 23. But the challenge in 24 is a different one, and it's more challenging than the hill that these names had to climb in 23. And once again, if they fail to deliver, they're too big to fail. The market, the economy cannot afford for these names to fail. You'll notice the theme here as we do it name by name, earnings by earnings. And the theme is 23 was the restoration of profitability in these names. They've overspent in 21, assuming that growth fueled by stimmies is long-lasting. That was a mistake. Their profitability plummeted in 22, and their stock performance reflected that. In 23, they managed to reduce costs dramatically, and thus improving their profitability, and their stock performances also reflected that. Now the question becomes, 24 is not going to be a year of, oh, we can expand multiples again based on cost cutting alone. It has to be the year of return to growth, which we haven't seen in 23. Growth actually went down. The challenge now becomes in 24, can they grow or not? Because cutting costs will not do it in 24. With that background out of the way, let's do them name by name. We begin with the big kahuna Apple. Now this might look a little confusing to you. It's all over the place, but it's really easy to understand. We're looking at Q3 earnings from this year, and then we'll go back to Q3 from 22, 21, 2020, and 2019. We'll do this with all of these names. And it doesn't matter what the company calls it, Q4, Q1, it's the third quarter of this year, meaning the quarter that ends in the month of September. And it's a really good quarter because in the third quarter, unlike the fourth quarter, we don't see the bump of the holiday sales. Likewise, we don't see the slowdown in Q1 in most companies. So Q3 is a really good pulse here to take as a measure for all of these names. Now, when we look at Apple here, keep your eyes on the blue line. It might be confusing, but once again, if you look at the blue line, sales growth in 2019, we know that we had a problem in the company Apple, which is the slowdown of growth. When the iPhone first came out, we've seen explosive growth in Apple, but then it becomes a maturing product and the growth slows down. So in 2019, the growth rate was 1.81% year on year. In 22, it was about 1%. And then we got the explosion of the stimmies and the artificial increase in demand. We have seen sales in Apple exploding to almost 29% worth of growth year on year. Now, with this explosion in growth, of course, the company has to invest more. So you see that the cost growth in orange also went higher. When it was growing by about 2%, less than 1% in the year of 2020, then it went higher in 21 by about 20.5%, but it didn't matter because growth was still intact. Growth was exploding. Everybody was buying with the stimmies, Macs, watches, iPhones. So the bottom line of the company, the net income growth you can see here in the chart in yellow, exploded higher when it was negative in the years 2019 and 2020. So there was already a problem with this company. But then came the stimmies and the profitability was restored, more than restored. Exploded higher with a growth rate of 62.16% in the year 21. And that is the growth rate year on year. The problem is, comes 22, now they assumed that this stimmy demand will last. Not knowing, of course, that all of this pump in demand produced inflation and the Fed will have to raise rates. And with raising rates, demand goes down. So in 22, we see that the sales growth year on year dropped to 8.14% from 28.84%. And sure, with that comes costs going down from 20.5% almost to 8% year on year. But with that also comes the drop in profitability. Now, better than 2020, better than 2019, at the rate of 8.30% year on year. But again, it's not the same company. It's not the same stock it was in 21. Now the company figures that out, says, okay, if growth is going to go down, you can see that indeed their assumption was right because sales growth in blue in the year 23 went negative. Matter of fact, almost negative 1% year on year. But because they were ahead of time in anticipating the slowdown of growth, and the company managed to cut the cost from a growth rate of 8% in 22 to negative 5.72% in the year 23 year on year, meaning that they actually reduced costs year on year. Doing so, even though sales grew negatively too, but because costs dropped by more than the drop in sales year on year, we see that the net income for the company improved from a growth rate year on year of 8.30% in 22 to 10.79% in 23. Not as good as the growth rate from the heydays of 21 when it was 62.16% year on year, but still better than 22, better than 2019 even. And therefore we see the operating margin of the company, which means out of every dollar that the company generates in revenue, how much does it keep in profits? In this case, the operating margin actually improved to 30.13%. And this is why we've seen a recovery in the stock. The problem now becomes, okay, they cut costs. Now we have a balance between the growth rate in sales and the growth rate in costs. Net income has stabilized. How do we continue to expand the valuation of this company? Because cutting costs at this point from a growth rate of negative 5.72 will be really, really difficult here. The key in 24 becomes, can they restore organic growth? Can they expand their sales year on year? Well, let's look at the indicators here. The most important product is the iPhone, and we can see that the trend here is moving negatively. It peaked in the year 21 with iPhone sales growth reaching 47% year on year. Now we see that the growth rate dropping in the year 22 to 9.66 and in this year to 2.76% year on year. This is a clear slowdown in growth here in iPhones. For the stock to grow in 24, it needs to restore the growth rate in iPhone sales. It needs to move from 2.76% year on year to over 10% year on year. As an example, okay, if iPhone is not going to make it because iPhone is a maturing product and folks are keeping their phones for longer, where can we find another avenue of growth here? How about China? Maybe China will be the one that will restore growth in this company. Well, we'll look at the trend here. It's the same thing. China sales peaked in 21 with a growth rate of 83.27% year on year. And then it dropped to 6.22% year on year. In the year 22, now we're back to negative growth rate by about 2.5% year on year this year, 23. So you can see here that absent of Chinese demand coming back, probably this is not going to be the source of growth of the company in the year 24. How about services? Sales growth. This seems to be the strongest point of this company, and we call it the racketeering revenue, the rent. The rent. Why is it the rent? Because the company doesn't have to do anything. It doesn't have to innovate or do anything to generate this revenue. All what they have to do is parasite over the transactions that you do as an iPhone user with other companies by charging the rent. the fee. And the more transactions you do, the more the amount of money generated by these transactions. But this revenue growth also peaked in the year 21 at a rate of 25.62% year on year. Then it went down to 5% year on year in 22. Now, in the year 23, it managed to recover back within the average range of about 16.30% year on year. Could we see services sales growth, for example, moving up in the year 24 to 20% to 22%? That is, of course, the key to expanding the valuation of this company. But here's something you got to keep in mind. Since the stock right now is trading at the same point it was in the year 21, the top from 21. Of course, the valuation differs because of share buybacks, but we are pretty much at the same point where the stock was trading at 21. The question now becomes, is it really justified? Are we at the same point in the health and the growth of the company today in 23 as it was in 21? Let's look at some numbers here. When it comes to sales growth, in 21 it was 28.84% year on year. In 23 it's negative 0.72% year on year. Profit growth in the year 21 was 62.16% year on year. In 23 was only 10.79% year on year. When it comes to iPhone growth, in the year 21 it was 47% year on year. In the year 23, it's only 2.76% year on year. China growth. In 21, it was 83.27%. In the year 23, it was negative 2.5%. Services growth was 25.62%. Now it's 16.30% year on year. So again, I'd leave this one to you. Does the stock deserve to be trading at the same highs of 21 when the growth rate is incredibly slower? The answer is probably no. But the assumption is that, yes, maybe the stock deserves to trade at the same highs of 21 because in the year 24, the growth will come back to the same rate that we're used to in the year 21. Again, I'd leave that to you. Do you really believe that we're going to get there or not? But here's my case for and against the bullish case versus the bearish case for Apple in 24. In the bullish case, we know that services revenue strength has been restored. And can we go back to the 20% plus growth rate in services in 24? Would it be big enough to counter any slowdown or let's say static growth in other categories? Well, it has to be strong enough to counter all of that. But maybe services will be the key here. And of course, if we have rate cuts by the Fed and the unemployment rate remains low, then we're probably going to see more applications for credit and buying of iPhones again. So we could see not only services revenue going back up, but also iPhone sales recovering. Under this scenario, easing inflation could lead to higher profitability because now you have more demand for iPhones, more services revenue, but the cost for the company keeps going down or at least stay static at this point. And that is the bullish case for Apple. Here's the bearish case. Negative revenue growth from China. We're now in negative. China recovery, it's up for grabs. We have some good signs, we have some bad signs. And most importantly, the Chinese consumer appears to be shifting from their die-hard favorite iPhone to other brands. If that continues, even if we see a resumption of demand in the Chinese economy, it might not help Apple by that much. Furthermore, since we're talking about rate cuts here, if rate cuts happen for the wrong reasons, because of an economic recession or in response to higher unemployment, then the job security for many Americans will become a concern, and not just Americans, but globally. And therefore, spending on iPhones will actually go down again and grow negatively. And of course, less transactions using an iPhone. So services revenue will also slow down, and maybe the growth rate that we see this year in services of about 16.30%, it could go down, plummeting to, let's say, 12% or single digits in a recession scenario. Likewise, if we have, let's say, a more conservative approach to investing, and we know that maybe bond yields have peaked, what if we see a rotation out of equities into bonds, taking the 23 gains and put them in a preservation mode by locking in bond yields? Well, the most owned company, most owned stock is Apple. That's where the money is going to come from and be parked in bonds. So now we know what the bullish case is. We know what the bearish case is for 24. How about Microsoft? What do we see here? And again, I'm using different formats here because I don't want to stick to one format and, get a lot of complaints about. So we're switching formats here. Maybe this one is easier to see for you. But again, you look at Microsoft, you'll see the same theme we've seen in Apple. So you look at the sales growth, 2019, 14%, 2020, 12%, 21, 22%. Then all of a sudden, sales growth went down to 11% in the year 22. So the normal and healthy growth range for Microsoft, sales growth that is let's say 12%, 15%, but 22% in the year 21 was an abnormal rate of growth, fueled by the stimulus, fueled by the liquidity. Of course, with that comes the rate of growth in costs. Usually in Microsoft, it's about 5 to 6% year on year. In 21, it shot up higher to 24%, assuming that growth is sustainable. So they have to spend more, they have to hire more. But then they found out in 22 that this rate of growth was not sustainable at 22%. So they had to cut costs, and indeed costs, the growth went down from 24% in 21 year on year to 13.23% year on year in 22. But it was not good enough. I mean, the sales growth was 11%, but the growth rate in costs was 13% above the growth rate in sales. The result, of course, is net income went negative by 14% year on year, even though the company maintained an operating margin in the 40s, which is pretty good, but net income profitability, the bottom line, went down by 14%. It was not normal to have a 48% growth rate in net income in 21. And in 22, the company got the memo and said, okay, in 23, we're cutting costs here because we know that the rate of growth in sales that we got in 21 is not sustainable. Well, guess what? The growth rate in sales normalized at 13% year on year in the year 23, and they managed to normalize the growth rate in costs back to the 5 to 6% range. Matter of fact, it was 5.5% this year. The result is the normalization of net income growth. 48% in 21 was not realistic. So they went back to 27%, which is in or around the growth rate that they got in 2020, 2019, which is between 20 to 30%. And the operating margin improved to 48%. So what is the message from this company? The problem in 22 was, hey, the growth rate in 21 is not sustainable. We assumed it is. So what we've seen is our sales going down and our cost was way too high. So our profitability went down. The stock went down. Okay, in 23, we cut the cost dramatically. And even though sales did not explode higher, sales went back to normal. Now we have a better balance and profitability has been restored in this company. And we see the stock moving back to the highs and exceeding the highs of 21. Now we'll talk about whether that's justifiable or not in a minute, but we go back to the conversation again from the intro of the video. In 24, for these companies to assume leadership and continue to grow, they need to show increasing growth rate of sales. You can't cut it anymore by cutting your costs. That's not going to do the magic anymore because all of these stock prices improved and then some. In other words, the stock is now saying the problem of profitability is behind us. We're actually looking for a year of magnificent growth in 24. Here's the challenge though. Where will the growth come from? Because the hottest product of Microsoft, Azure, the growth rate has been slowing down for years now. It's been a trend. 2019, it was 59% year on year. 2020 was 48% year on year. 21, the increase in demand with the stimulus and all of that, it went up higher to 50% year on year. In 22, it went down to 35% year on year. In 23, it did not come back. It actually went down by 29% year on year. In other words, all what Microsoft has done in 23 is just cutting costs and improving the profitability. But the growth of the company is actually slowing down dramatically. So the challenge in 24 becomes, how do we increase growth? If it's not going to come from Azure, where will it come from? These are the kind of questions I want you to think about, because if you look at 21 versus 23, Microsoft stock is now trading above the highs from 21. Is it justifiable or not? Well, let's look at the numbers here. The rate of growth in sales was 22% back in 21. This year, it was down to 13%. The growth in profitability was 48% in 21. It went down to 27% in 23. The growth in the hottest product, Azure, was 50% year on year in 21. This year is 29%. Yet the stock price is trading above where it was trading in 21. In other words, there are a lot of assumptions here that 24 will be a great year. We will see numbers such as the numbers we've seen back from 21. If that assumption is wrong, we got a problem here. So let's go over the bullish versus bearish case. In Microsoft, the bullish case would be, sure, Azure may be slowing down, but all of this investment in AI will produce more products, newer products that will replace the growth rate in Azure. Likewise, maybe the consumer is slowing down after years of inflation and higher rates, but business-to-business spending remains strong. Companies are still flush with cash. And if rates go down, maybe they can borrow a lot easier and spend on more products for Microsoft in the year 24. The bearish case for Microsoft, well, AI spending will lead to lower profits. They have to spend more. It's a race. Now the question becomes, okay, if you're going to spend more, we got the same problem we got in 22. Absent, of course, of your growth rate moving higher. Sales growth, well, how is that going to come from anything if Azure growth continues to slow down? You might go back to the same problem from 22 here. Likewise, if years of inflation and higher rates lead to weaker consumer, then businesses, even if they have the cash, if the feedback is consumers are getting weaker, then what is the point of spending if the end user of their products, the consumer, is getting weaker? And that could be the bearish case for Microsoft in 24. Now let's move to Google, aka Alphabet. And again, might be a little hard for you to see here, but one step at a time. We begin with sales growth in blue. In 2019, it was 20% year on year. Went down in 2020. It was a recession kind of year. Understandable. From 20% to 14% year on year. Then came the stimmies, stimulating demand, maybe overly stimulating demand of the economy. And sales grew by 41% in the year 21. That's year on year, of course. Now, if you move your eyes to the red line, which is the growth rate in costs, you can see that in 2019, the company had a problem. Costs were growing faster at a higher rate than sales. It's the same problem in 2020. But in 21, we have seen the rate of sales exceeding the rate of growth in costs. 41% versus 30.80%. Of course, with higher sales comes more hiring. They have to spend more on the products. So costs will go higher, no doubt about it. But so long as there is a gap between sales and cost favoring sales, then you're doing pretty good and the profitability of the company improves. So if we look at the yellow line, it moved to 68.36% year on year. This is the profits, the bottom line. In the year 21, it grew by 68.36% year on year. Really impressive. Of course, the company assumed that, this rate of growth is sustainable. What they didn't know is it was a bump in 21 and 22 as the Fed began raising rates, as inflation became a problem for the economy and consumer spending. What happened is sales went down from a growth rate of 41% year on year to 6% year on year, but the rate of growth in costs were still high at 13% year on year. Well, no wonder why we see the profitability in the yellow line, net income growth, going down, a loss of 26.54% year on year. And this is why the stock of Alphabet did pretty bad in the year 22. Here comes the year 23. What did the company do here? The growth rate in sales improved from 6% year on year to 11% year on year. So unlike, let's say, Apple, where the sales growth did not improve at all, Microsoft, where it normalized, we see here in Alphabet, it improved, but it is still below the average from prior years. But most importantly, they also slowed down the growth rate in costs from 13% in 22 to 6.64% in 23. Now we have a gap in favor of the company because sales growing at 11%, costs at 6.64% year on year. So we see the net income improved by 41.54% year on year. Of course, it is shy from the 68.36% back in 21, but the restoration of profitability led to a recovery in the stocks of these companies, in this case Alphabet, in the year 23. Now, can you continue to expand the valuation of the company to push the stock higher by continuing to cut costs when you already have a growth rate of about 6.5% year on year? That's going to be really difficult to see. So now it becomes imperative for the company to increase the growth of sales again to 20%, 25%, 30% to justify what happened in the stock price this year and build on what happened to the stock price this year. Well, let's look at the highest growth engine of this company, which is YouTube. What we can see here is that the growth rate in YouTube, the revenue from YouTube, has been declining since 21. We got a peak at 43% in 21, and then it dropped down to 1.86% year on year in 22. Now it recovered in 23 to about 12% year on year, but that is still shy from 19% in 2019, 32.41% year on year in 2020. And the key for the stock to keep the progress it did in 23 and build on that progress is for YouTube revenue growth to go back to 20%, 25%, 30%. So we look at the stock performance in 21 versus 23. We're not that far from the peak of 21. What about the numbers though? Sales growth in 21 was 41%. In 23, it's 11%. The bottom line growth in profits was 68.36% in 21. In 23, it's 41.54%, shy of the number from 21. The growth in YouTube was 43% in 21. It is now down to 12% in 23, even though the stock price and performance is really close to the peak of 21. In other words, just like in the case of Apple, in the case of Microsoft, here in the case of Alphabet, the stock price is a little ahead of itself right now. It is assuming that we're going to go back to the same growth rate that we got from 21. In 22 was just a bump in the road, and growth in these companies will be restored in 24, not just to match, but exceed the growth rate in 21. Big assumption? Yes. I'll leave that up to you again. Do you think it is reasonable to have these stocks at the same highs or even above the highs of 21, or are we getting a little ahead of ourselves here? Here's the bullish versus the bearish case for Alphabet in 24. The bullish case. This company has the healthiest cash flow position among the big caps, the Mag 7, and it could lead to expanding AI projects and increasing future revenue growth. So if the company spends more, it might be bad on paper, but if they promise products that would expand the revenue growth and profitability of the company in the future, we can continue to have that as an excuse to expand the valuation and the multiples for this company in 24. On the other hand, the bearish case is the ability to cut loss is limited. So now, in the year 23, we saw a recovery because of these companies cutting their spending. Question now becomes, are they going to be able to cut spending even more and just continue to expand valuation based on cutting spending, improving profitability, but not really expanding growth? That's a big question mark here. Can they continue to cut loss when they have an AI competition here with Microsoft, with Oracle, with many other software and cloud providers? The bearish case says we see that hard to believe here. Cutting costs not going to happen in 24. They have to increase costs in this AI race. On the other hand, will the increase in cost be also complemented by an increase in the rate of growth of sales? Not so fast, because what we see right now is a slower consumer demand environment. And the bread and butter of the company right now is ads. It's not AI. So slower consumer demand would lead to less spending on ads. Now the company goes back to the same problem from 22. It has to spend on AI. That's the future of all of these companies. At the same time, the growth rate in sales will have to slow down if the consumer slows, because the business of advertising happens to be really cyclical. And this is really important for us to understand to assess whether these stocks and these companies will continue to outperform into 24 or not. Not just from a weighting perspective alone, but also when you look at the micro aspects of these companies and what they say about the economy. Next, we have Meta. And this is probably a better case than Apple, Microsoft, and Alphabet, at least for this year. And we're using another format here. Maybe you like this one a little better, because there's a huge gap between net income and the growth rate of everything else. So we're leaving the numbers here. We begin, per usual, with sales growth. In 2019, it was 29%. 2020 went down to 22%, then exploded higher in 21 because it was a year of artificial fluffing up of demand. It went higher to 35% year on year. Of course, Meta, led by Zuckerberg, assumed that this kind of mania will continue in the economy, and they decided to ramp up their spending to 38% year on year, which is way higher than the 28% rate of growth in costs in 2020. Metaverse, all of that mania. Well, comes the year of 22, and now we see demand plummeting. So the rate of growth in sales was negative 4%, but they continued to spend like a drunken sailor, even though the rate of growth in costs went down from 38% to 19%. The gap between the growth rate in sales and cost was way too large, so the stock crashed. We've seen the net income growth crashing to a stunning minus 52% growth rate year on year. The company lost a lot of money and the stock crashed down. Comes the year of 23, which Zuckerberg dubbed as the year of efficiency. What happened in 23? We have seen sales growth recovering a little bit to 23% year on year, still shy from even 2019 numbers of 29% year on year. But Meta has been really aggressive in cutting costs, firing thousands of employees, not spending on the metaverse as much as they used to. So we see that the rate of growth in costs went down to negative 7%. Now we have a big gap between the rate of growth in sales and the rate of growth in costs, but this time around in favor of the company. So what happens? Profitability increases. We see net income growth exploding higher by 164% year on year. And therefore we have seen a recovery in the stock in 23. Now in the year 24, Meta will not be able to increase profitability by cutting costs anymore, because the growth rate in costs year on year is already minus 7%. The law of base effects will kick in. Mathematically, it's really hard to reduce the number of the rate of growth in costs year on year when your base is minus 7%. Likewise, mathematically, really hard to expand the growth rate in profits when your base is already a positive rate of growth of 164%. So what happens now? For the stock to continue to grow and perform, we need to see a restoration of growth in Meta. Sales growth need to recover to the 30s, maybe 40s. And they need to be really careful in expanding costs at this point, not to feel that they're out of the woods. And therefore, we could see net income growing positively, not as high as 164% year on year, but maybe at 30% or 35% year on year. That's what could keep the stock going higher. But if they have a hard time in restoring and improving the growth rate in sales, then the company will be in another problem, which is growth now is slowing down, but they don't have the aid of cutting costs, meaning that costs will either stay the same, if not even increase in 23. If that is the case, then profitability will become a problem again for this company. In any case, the stock is not at the highs of 21, but really close. So let's see how was the growth back at 21 versus 23. The growth rate in sales was 35% in 21. Now it's 23% in 23. The growth in profits in 21 was 17%. The growth in profits this year was 164%. Higher, it's going to be harder to maintain this number. Now, is it justifiable that Meta is trading where it is right now? I think based on the restoration of profitability, it is. Maybe it's a little higher than where it's supposed to be, but the key of expanding the valuation and getting it back to the highs, maybe all-time highs, requires the restoration of growth. So let's look at the bullish versus bearish case for Meta. The bullish case is the return to profitability could lead to higher spending and higher growth. The problem is, where are they going to spend? Metaverse? If they keep doing that, that's going to be a problem. If they spend on bettering the platforms that they have to attract more ad revenue, then that's going to be good. But of course, if we have any limitations now, since we're heading into election season, if we have at least any threats of limiting TikTok access here in the US, that could be good for Meta, at least from a money flow perspective. That the loss of TikTok will be of benefit of Meta, and Meta will expand the revenue. Whatever TikTok was making in the US, that's going to flow to Meta. Big assumption, but if we have that assumption by the investors, money will flow into Meta stock. The bearish case, on the other hand, says, well, they can't rely on cutting costs anymore. They've already cut costs. They can cut it again, but that's not going to improve the profitability by triple digits in 24. So now they have to rely on expanding growth. Problem is, as we said, this is going to be an elections year, and we have a ban on political ads on Facebook, so that's going to limit the money, the growth. When we talk about where will the growth come from, well, it's not going to come from political ads anymore. Likewise, we have all of these problems from the regulatory pressures here in the EU, the negatives of the exposure of kids to these platforms. We could see fines, we could see limitations of ads. Again, that's all going to hinder the growth that Meta needs to expand their valuation in 24. Likewise, if the economy slows down, if we head into a recession environment, maybe that's why we're going to do rate cuts. If that is the case, then an economic slowdown, as we talked with Alphabet, the business of advertising is really, really cyclical. So any slowdown in the economy means less dollar spending on ads. That's going to be a problem for Facebook or Meta, whatever we want to call it. Doesn't matter to me. And of course, the other problem for Meta is the over-concentration in positioning. Notice that if you look at the chart of Meta, we barely had any pullback or correction this year. It means that folks were just piling in money into the stock without really booking profits. If they need to rotate or have a different strategy for 24, such as let's move to the smaller caps in the scenario that the economy actually does better, or let's move to bonds in the case of the economy doing worse, a recession scenario, then money will come out of Meta. And what about another Max 7 here? Tesla, I don't know why it's included, but since it is part of the Max 7, we have to talk about it. Here's a nice chart for you. Well, what are we looking at here, Maverick? Let's take sales growth one by one. It's the green column right here. So you see in 2019, the company was already in a lot of problems here. The growth rate in sales was negative by 8%. A lot of folks were shorting Tesla. Oh, they're not going to make it. The cash flow is going to be bad. And that thesis, by the way, was very valid all the way to 2020 and 21, when the pandemic took place and we have seen the stimmies and zero interest rates, and then all of a sudden demand was fluffed up in buying these Teslas. So the growth rate in sales went from negative 8% in 2019 to positive 39% in 2020. And this boom continued all the way to 21. The growth rate in sales went higher to 57% year on year. 22 was also good for Tesla, 56% year on year. Then in 23, notice the difference here between Tesla versus Meta versus Microsoft. Those companies are recovering in 23. Tesla's doing worse. This is why I disagree that Tesla is a magnificent 7. Because right now in 23, the growth rate in sales went down from last year's 56% year on year to 9% year on year. Here's the problem though. When you look at costs, 2019 minus 3.5% year on year. Of course, as the boom happened from 2020 to 22, with the growth rate in sales comes the growth rate in costs. But notice the gap that you see between the green and red columns here. In 2020, sure, the growth rate in costs went higher by 31.22%, but it was shy of the green column, which is sales. Similar story in 21. It went higher to 50.52% year on year, but there was still a gap. Sales outgrow costs. But it was a warning sign that the cost was catching up with sales here. Comes the year 22, and now the growth rate of costs exceeds the growth rate of sales. A reminder, in 22, the rate of growth of sales was 56% year on year. As you can see here, the rate of growth in costs, 59% year on year. That's a problem. That's a warning sign. This gap expanded in 23, even though the growth rate slowed down for both sales and costs. But the slowdown in sales was much bigger than the slowdown in costs. So we see that sales went down to a growth rate of 9% year on year, but costs went down to a growth rate of 19.29% year on year. Well, what is that going to do to profitability? As you can see in the white column here, profitability margins plummeted. A reminder, this company was in deep trouble back in 2019. Folks were shorting it. You remember Chanos. He had the right thesis, by the way, until, of course, the stimmies changed the picture, because you look at the net income growth in 2019 for Tesla, negative 54%. But then with the stimmies and the fluffing up of demand, the growth in net income in 2020 improved to 131% year on year, then 21 skyrocketed to 389% year on year, cooled off a little bit in 22 to 103% year on year, but it was still impressive. We have never seen anything like this in the auto industry. But this year, we go back to the same problem of the stock in 2019. The profitability, we're back to negative growth rate of 44%. And maybe that explains why the stock did not really recover to the highs of 21. But the question now becomes, is it even justifiable for the stock to be traded at these levels right now with the numbers and the growth rate that I just showed you? And again, in 21, the growth rate of sales was 57%. In 23, it's only 9%. The growth rate in the bottom line profits was 389% in 21. Now it's negative 44%. Clearly, this stock doesn't deserve to be traded at the highs of 21, and honestly, it doesn't deserve to be traded at where it's trading right now. But maybe investors see the light at the end of the tunnel, that maybe we'll see a restoration of demand and a restoration of profitability in this company in 24. So let's discuss the bullish versus the bearish case. The bullish case for the souffle Tesla. Rate cuts could lead to a restoration of demand and pricing power. You reduce the cost of borrowing, maybe you're going to see more demand in buying these cars. If we see demand coming back, Tesla can increase pricing again. Likewise, the cash flow for the company is really good right now versus 2019, which means that unlike 2019, if they have a problem with the stock, they can initiate a large buyback program and recover these shares and push them higher. Likewise, as inflation cools, we see lower commodity prices helping reducing costs. The problem for Tesla, as we said, is the gap between costs and sales. Demand went down because of higher rates and inflation, but the cost for the company was still high. Cost of copper, nickel, the batteries, aluminum, wages. Maybe now with inflation cooling off, we see the pressure from cost going down and rate cuts bring back demand for Teslas, and we see a better balance here. And the last one is we have probably, not confirmed yet, but we're probably going to have the IPO of SpaceX. Could that initiate a sort of a mania that could also benefit Tesla? Maybe that's going to be a bullish case for the stock. Now, the bearish case for 24 for Tesla. If the economy indeed slows down and we see rate cuts because of a recessionary-like factor such as an increase of the unemployment rate, then it doesn't matter. You can cut rates all you want. The demand will still be down. Folks are not going to take the risk and borrow money even at a lower rate to buy a Tesla when you're worried about your job. Likewise, the increase of supply in the used market, you have to understand all of that demand in 2020, 21, even 22. Well, not everybody's going to keep the car. A lot of folks need to upgrade. A lot of folks might have economic difficulties. They have to unload these cars. Supply increasing will push demand down. And see, we don't have these kind of problems with Meta, with Microsoft, with Alphabet, maybe in Apple in a certain degree. And this is why I disagree with including Tesla in the Max 7s or even the big caps, because it is even more cyclical as a business than advertising. Anyhow, aggregate demand in the housing market, let's say rates go down, and now folks would say, okay, you know what, pricing is not going to go down. home prices will not go down, but mortgage rates are a lot better. You know what? Let's use the savings that we have to go ahead and buy a home. But when you do that, you have to reduce spending. Maybe you have to cut spending. You have to unload your Tesla, for example, for your offer in the house to be competitive. In this kind of environment of a restoration of demand in the housing market could actually work against the auto industry and specifically Teslas. Likewise, if we assume that we are heading into an economic slowdown and gas prices go down and stay down, well, that's going to make buying EVs less attractive. And we already see that problem right now. And the last one, since we have an election year coming out, what about the political risk from Elon Musk? We know that he's a loose cannon. He could say something that upsets prospective buyers of Teslas, cause folks to get really angry and they dump their Teslas. You always have to factor this kind of risk in this company. Next, we have Amazon. And again, I regret the graphics that I'm using here because it's kind of hard to see, but let's begin with the sales growth here. The line in green this time around. You can see that in 2019, it was 24%. This company peaked a little before everybody else. So the peak growth in Microsoft, in Apple, in Alphabet, and Meta was 21. The peak growth in Amazon was 2020 because everybody was at home, we're locked up, and we can only use Amazon to deliver all of the goods that we need. So the growth rate in sales in 2019 was 24% year on year. It exploded higher to 37.38% in 2020. Then it went down to 15.25% in 21, went even lower in 22 to 15%, and it slid further down in the year 23 to 12.57%. Now you have to understand something here. When you look at the stock price of Amazon, it did not recover the highs, such as Microsoft, for example. Why? Because look at the growth rate in sales from 2019, 24%. Now we're at 12.57%. So again, the rate of growth in this company has been slowing down dramatically. And this is a trend that needs to be reversed for the stock to appreciate in the year 24. Because sure, you can cut costs all you want. The growth rate in costs was 26.43% in 2019. Naturally, it went higher to 38.26% in 2020. Higher than the growth rate in sales. But nobody paid attention back in 2020 because they did not see that as a problem. You got to recall that this company, if you look at the stock, it peaked and it dropped before every other stock in the big caps because of this problem. Then the rate of growth in costs went down to 10.19% in Q3 of 2021. It went a little higher, 17.56% in the year 22. The problem here is it went back above the rate of growth in sales, so 22 was a bad year for the stock. This year, just like any other mega cap technology stock or company, they managed to reduce the growth rate in costs to 5.88%. Yet the growth rate in sales normalized. Sure, it's lower than average, but still a lot higher than the 5.88% growth rate in costs at 12.57% year on year. So we see the net income exploding higher in the year 23 to a growth rate of 244%. So in 21, the stock was doing pretty bad, was sliding down before everybody else because the growth rate in net income was minus 50.15%. 22 was minus 9%. Now it's up to 244%. Here's the problem though. Mathematically, the law of large numbers, it's really hard to build on large numbers. It's really hard to keep the same growth rate in net income for 24. It's going to take a magnificent reduction in cost or a magnificent explosion in the rate of growth in sales. Now, we know that it's going to be really, really hard for these companies to just continue to cut costs. They've already cut a lot when they have to spend on AI and continue to be competitive for the future. So the key for the stock to grow in 24 is expanding the rate of growth of sales. Well, gee, where would that come from? If the highest growth product for Amazon is AWS, the cloud product, and the trend here is clear. The growth rate for this product has slowed down dramatically. 2019, it was 34.67% year on year. 2020, it went down to 28.97% year on year. 21, with the mania, it went higher again to 38.86% year on year. But since then, it's been going down 27% year on year in 22 and 12.27% year on year this year of 23. Okay, so if you look at the trend here, it is highly unlikely that the growth in AWS will be the catalyst of bringing back growth of sales in this company, which means that the stock will have a hard time moving higher from this point on, unless we see a restoration of demand in the economy via rate cuts. We'll talk about that in a second here, but again, Let's look at the 21 performance of the stock versus 23. In Amazon was short. We're not at the 21 highs because back in 21, the rate of growth in sales was 15.25%. This year, we're down to 12.57%. The growth in profitability was negative 50.15% back in 21. The growth rate in profitability this year, 244%. Year on year. The growth rate in AWS was 38.86% year on year in 21. We're now down to 12.27% year on year this year, 23. But here's how Amazon can grow into 24. As a stock, as a company, the bullish case is rate cuts leads to restoration of demand and consumer spending. That's it. If that assumption is wrong, then Amazon will probably go down again. The stock, the company, the profitability, everything will go down because the bearish case says slower consumer demand leads to lower growth. If that's why we're cutting rates, then that's going to be a problem. And we're going to go back to the same problem of 22 for most companies where now you see demand slowing down, your revenue going down, but your costs are way higher. At this point, how do you cut costs? In 21, you had excess. You can shave that off. But now you don't have the excess. Now you have to lay off employees. And that's going to lead to a higher unemployment rate in the economy. Likewise, the higher physical cost footprint in an economic slowdown, that's a negative because they have warehouses, they have employees, they have trucks, they have wages, unlike the software companies, the companies that rely on advertising. So the footprint here is too much that if they need to cut costs, they're going to have to be really, really aggressive. And that's going to have a negative impact not just on Amazon, but the entire economy. And of course, if we need to restore the rate of growth in sales to move this stock higher in 24, how can we do that if the highest growth product, which is AWS, is dropping? And it could drop to single digits worth of growth. That would be a problem for the company. And last but not least, Nvidia. And Nvidia is an exceptional case here. Let's take it one step at a time. We begin with the growth rate in sales in purple, I guess. In 2019, it was a negative 5%. Most of these companies were having a hard time in 2019. Back then, we were talking about the end of the cycle, maybe a recession coming. Then, of course, came the pandemic, the Great Reset, and the stimmies, and the rest is history, of course. So we see that the rate growth or the growth rate in sales improved to 57% in 2020. Demand on PCs, demand on cryptos, demand on gaming, staying at home. 21, the growth rate in sales held, be it at a lower pace at 50% year on year. Then in 22, it went negative to 17%. With the crash in Bitcoin, with a lot of folks now having to go back to the office and no need for PCs and laptops anymore. And then, of course, in 23 came the AI mania. And the growth rate in sales exploded to 206% year on year. Now, the growth rate in costs, as you can see in red here, in 2019, we had a negative growth rate in sales, but we had a positive growth rate in costs, 15%. So the stock did not do pretty good. In 2020, the growth rate in costs was 58%, but of course, the market gave a pass to Nvidia and to many other companies that, okay, you can maintain that at 21. And that assumption was right. And we've seen a gap. The costs went down. The rate of growth in costs went down to 25% in Nvidia, while the growth rate in sales maintained at above 50%. The gap produced higher net income, and this is why 21 was a really good year for Nvidia. But again, a reminder, in 22, the growth rate in sales was a minus 17% because Bitcoin crashed, going back to the office, you know the deal. But the growth rate in costs went higher, 31%. So we had a massive gap here in net income. You can see in the white line, it went negative. So it was a bad year for Nvidia in 22. Before the AI mania even began, the company, just like any other company that we talked about, was planning to cut costs aggressively. And they did that. In the year 23, costs went down to 16% from a growth rate of 31% in the prior year. But the cherry on top was the AI mania and the explosion of demand for these AI chips. You combine a reduction in cost with an improvement, not just an improvement, but an explosion of the growth in sales year on year. What do you get? You get an improvement in profits in net income worth 1,259% year on year. Unheard of. We've never seen anything like this in business before at this large scale. We've seen it in smaller companies. That goes without saying. But in a company with a valuation of over $1 trillion, almost, it's never heard of. Now, the challenge with this company in 24, unlike the previous companies that we talked about, each one has a unique challenge. But this one is more unique than everything, really. The problem here is the law of large numbers. How do you maintain these huge numbers that you got in 23? How do you maintain a growth rate in net income of 1,259%. How do you maintain a growth rate in sales north of 200% year on year? So when we look at the sequential growth for data center, because Gaming did not do pretty good. Gaming is not doing pretty good right now. The automotive segment for Nvidia not doing so hot, but it is all about data center. Look at the law of large numbers here. This is the sequential quarter over quarter revenue growth in data center. So Q3 22, that is a year ago, it was 1%. This is before the mania. In 22, it went down negative 6% year on year. Q1 of 23, when we began talking about the AI mania, went up by 18% year on year. And the famous Q2 of this year, when the revenue growth in data center quarter over quarter, if I said year on year, I was mistaken, it's quarter over quarter, went higher by 141%. The problem now becomes the law of large numbers, hard to replicate. So we see that the sequential growth rate of revenue quarter over quarter plummeting from 141% to 41%. And the fear here for any Nvidia investor is, what if the growth begins to slow down a little bit? And now we see that the sequential growth quarter over quarter in the revenue for data center goes down to 30%, 25%. The next thing you know, 16%. We begin to normalize again. If that is the case, then we're going to realize that the explosion in demand and revenue in Nvidia was transitory. That's the problem for this company. But once again, we know that the stock is trading way above the high of 21. Justified or not? Let's look at the numbers here. The rate growth in sales, 50% in 21. 206% in 23. The growth rate in the bottom line profits, 49% in 21. Already impressive. Got even more impressive to 1,259% in 23. Looking at these numbers alone, is the stock performance in 23 by Nvidia justified or not? The answer is absolutely yes. The challenge becomes, can you maintain that kind of growth or not? Is it really transitory or not? Because if it is, then there's a big crash of the stock coming in 24. So let's look at the bullish versus the bearish case for Nvidia. And at least for the stock, the bullish case says we might see a chase of performance by money managers in 24, who probably missed out on the rally in 23. If that happens, it could be good for the stock, at least in the first quarter, until a next report shows up. But the most important one is this one here. The hope that rate cuts will make corporate spending easier, and we will see more spending on AI chips by Nvidia. If that is the case, then we can maintain the growth rate, maybe expand on it a little bit. Likewise, higher crypto prices, we see that Bitcoin has been rallying as of late. This could restore demand for other chips by Nvidia, as we probably could see the crypto mining boom 2.0. Now, the bearish case from Nvidia goes as the following. The loss of pricing power due to competition. What are we hearing right now? AMD, Microsoft, Intel, Amazon, all coming out with their own AI chips. More products in this arena here will reduce the pricing power that Nvidia enjoyed. A huge part of the explosion in revenue and profits for this company this year was due to the fact that they've been selling chips at 40 grand a pop. Well, if you reduce that pricing power, now the pricing has to go down and maybe cut by half. It will become really, really hard, in combination with the law of large numbers, to continue to see the growth rate in sales and net income as we've seen before. We might even go negative year on year, and that would be a problem for this company. Likewise, if the economy is heading into a recession, we could see demand for these chips going down because companies will say, hey, our consumers are now getting weaker. We have to be really careful with spending here. Not only Nvidia loses the pricing power, but the demand too. That would be a double whammy. The law of big numbers. We talked about that. Really hard to follow up in big numbers as we've seen in 23. And the last one is the lofty valuation. If we have a loss of pricing power, if we have a loss of demand, at least a reduction in demand, it will be really, really hard to keep this valuation here. Folks say that the valuation is cheaper today than 21. What they don't understand is, what if the expansion in revenue, profitability is transitory due to the pricing power or the explosion of demand because of the AI mania? What if these slow down? Then all of a sudden the valuation is more expensive than ever and the stock goes down. Now lastly, looking at the quarter that was, the third quarter of this year, can we at least pick which stock in each category is the best among the Mag 7? Here are the numbers that we just talked about: sales growth, profit growth, operating margin for each company, price to sales ratio, and the forward PE ratio. In the sales growth category, who wins? Obviously Nvidia. We're just looking at the numbers here. No judgment by me at all. Nvidia wins. Profit growth. Nvidia also wins. Hard to even compete with these numbers. When it comes to the operating margin, Nvidia takes it too, at 57.48. When it comes to the price to sales ratio, which company is the most attractive? The answer is Amazon, 2.86. When it comes to the forward PE ratio, which company holds the most attractive valuation? The answer is Meta at 20, cheaper than all of these companies. But again, when you look at who's the best stock here, which one is the best stock, I should say, you have to combine all of these factors and the context that we just talked about. And in my opinion, at least this is the maverick judgment, the king for the Magnificent Seven, so-called, remains Microsoft. Why Microsoft? Because they went back to the same sales growth, profitability growth from before the mania. On top of that, they managed to improve the operating margin to 48%. So sure, the stock is expensive at 12.75 times sales, almost 30% forward PE, but it's a lot cheaper than Apple when you look at the earnings alone. It is certainly way better than Tesla, way better than Amazon. When we talk about the cyclicality of Amazon, much better than Alphabet when it comes to the profitability. You look at the operating margin, 48 versus 28. I think that deserves a higher premium. Nvidia is a special case because it had a unique bump in demand and profitability this year, so you can't really compare it with anything else here. It comes a battle between Microsoft and Meta, really close here, which one provides the best value. I go with Microsoft because of the cyclicality of the ad business for Meta and the fact that they're going to have a hard time expanding growth while cutting costs again in 24. So for now, the king of the Mag 7 remains Microsoft, but it is not immune from an economic slowdown. If the economy slows down, then the valuation will be exposed as too high and the stock sells off in 24. But this is the setup. This is what you have to understand. These names are too big to fail. Each one has a unique challenge in 24. Each one has delivered this year in restoring the profitability by cutting costs. They got rewarded by the market to the tune of going back to the same prices of 21 and exceeding those prices. Now the challenge becomes, okay, you showed me how you can cut costs and become profitable again. In 24, can you show me that you can go back to revenue growth? Because this has been a problem for all of these companies before the pandemic. Even before the pandemic, 2019, 2018, we were talking about the slowdown revenue growth. Then came the stimmies and came the AI mania for other names. But can they do it organically in 24 or not? That's going to be the key for these names and the key for the stock market. If these names underperform, the stock market goes down just because of the weighting alone. And the last point I want to make, in 23, it was easier to recover the stock market by recovering these stocks, the big guys. Why? Because reducing costs is something in their hands. They can do it. They can fire an employee. They can spend less. But expanding growth in 24 is not in their hands. Expanding growth in 24 depends on the health of the economy and the consumer. And after years of inflation, years of higher rates, can rate cuts alone stimulate that demand and increase the revenue growth in these companies? Your homework right now is, can you look at instances when the Fed cut rates from such a huge hiking campaign? Did that really restore demand in the economy, or was rate cutting happening for the wrong reasons? And I think the answer to that question, well, we can't have a definitive answer right now, but the answer to that question will hold the key, not just for the economy, but for these names. And the key for these names is the key for the entirety of the stock market. With that, folks, we have reached the end of this video. I hope you found it informative and made you think a little bit here. If it did, kindly press the like button, subscribe to the channel, consider becoming a member. We'll do more of these videos for other sectors of the economy, other sectors of the market. You might be interested in watching these videos, which will be exclusive to the members of this channel. And of course, leave us a nice comment. That's always appreciated. Unless, of course, you're drunk from the Christmas party, you might not want to expose yourself too much here. But with that being said, folks, Merry Christmas. Hope you had a good holiday here. And we're going to go back to business tomorrow. But for now, this is all I got for you. Thank you for listening. Thank you for watching. And I will talk to you again tomorrow. Good night.
Merry Christmas, you filthy animal, and a Happy New Year.